Hello and welcome. Today we're diving into one of the most legendary and, frankly, controversial deals in financial history, the leveraged buyout of RJR Nabisco.
$25 billion. Back in 1988, this number was just staggering. It represented the largest corporate takeover in history, a true battle of Wall Street titans for a company whose products were, well, in millions of American homes.
All right, so here's how we're going to break this down. First, we'll get to know the company itself. Then, we'll dive into the wild battle for control, dissect the winning deal, look at the brutal aftermath, and finally, pull out the key lessons from this legendary story.
So, let's set the stage. What exactly was RJR Nabisco, and why was it so perfectly ripe for a historic takeover?
Okay, so by 1988, RJR Nabisco was an absolute giant, a massive food and tobacco conglomerate. I mean, this thing was a true cash cow, just churning out billions from brands everyone knew, like Camel cigarettes and Ritz crackers. But here's the thing. On Wall Street, analysts looked at it and saw a company that was undervalued and frankly bloated, with a ton of corporate excess. A lot of that reputation was thanks to its flamboyant CEO, F. Ross Johnson, who was kind of famous for his lavish spending and his whole fleet of corporate jets.
And this is where it gets really interesting. Johnson, believing he could unlock the company's real value and, let's be honest, make a fortune for himself in the process, was the one who actually lit the fuse on what became one of the most ferocious bidding wars finance has ever seen.
The whole thing just exploded with incredible speed. Johnson kicks it off with a $75 per share proposal. But just a few days later, the legendary buyout firm Kohlberg Kravis Roberts, you know them as KKR, jumps in with a hostile bid. For the next 6 weeks, the offers just flew back and forth. It all came down to this dramatic, down-to-the-wire finish that had the entire financial world completely captivated.
Now here is where it gets super fascinating. The board ends up choosing KKR's lower bid. So why on earth would they do that? Well, it really boiled down to two key things: certainty and strategy. KKR's financing just seemed more stable, more of a sure thing, and their promise to keep the company together, instead of just immediately selling off the entire Nabisco food division, was a lot more appealing. Plus, let's just say the board had become pretty wary of Johnson's clear self-interest in the whole affair. All right, so let's pop the hood and look at the financial architecture here. How in the world was KKR going to pay for this corporate giant?
And this chart right here, this is the absolute heart of a leveraged buyout, or LBO. I mean, look at that. The deal was financed with an incredible 87% debt. Only 13% of the money was actual equity from KKR and its investors. That leaves you with a razor-thin cushion if anything, and I mean anything, goes wrong.
This table just puts the sheer scale of the financing into perspective. We're talking about over $25 billion in new debt, coming from bank loans and those high-yield junk bonds. And all that money was being used to buy out the existing shareholders, refinance the company's old debt, and of course pay hundreds of millions in fees to all the bankers, lawyers, and advisors.
So to handle these absolutely massive interest payments, KKR got creative and pretty risky. They used these innovative securities called payment-in-kind notes, or PIK notes. Basically, it let RJR preserve its cash by paying the interest with more IOUs. So you're piling on more debt to service the debt you already have. You can see how that could get dangerous.
You know, the Wall Street, this deal was an absolute bonanza. The fees set new records, and it sparked this really heated public debate about conflicts of interest and corporate greed, especially that $75 million fee that KKR paid to itself with borrowed money from the company it had just bought.
So KKR won the battle, but the huge price they paid, combined with that mountain of debt, immediately put them in a really dangerous position. This is what finance folks call the winner's curse.
See, KKR's financial models, the math that made the deal look possible, it all relied on these wildly optimistic growth projections, over 21% a year. But the reality? Well, the company's cash flow was almost totally flat, growing at maybe 2 to 3%. And that created a massive, immediate cash crisis.
And that brings us to this number. This represents a critical failure in the original plan. By 1990, the company was so financially strained that KKR had to inject $1.7 billion of its own investors' money that was never supposed to be part of the equation, just to keep RJR from defaulting on all its loans. It was basically a massive, unplanned bailout.
The day-to-day reality of managing this debt-laden company was just brutal. That debt completely crippled any kind of flexibility, which led to painful layoffs for thousands of employees.
KKR had to start selling off major assets just to pay down loans. And then, to make matters worse, the junk bond market collapsed in 1990, making it almost impossible to refinance. They had won the battle, sure, but now they were in charge of a company that was fighting for its life.
So how did KKR finally get out of this incredibly difficult investment? And what kind of legacy did this legendary transaction leave behind?
Yeah, there was no quick victory lap here. KKR's exit was a grueling, multi-stage process that stretched out for over 15 years. It started with taking the company public again in 91, then a really complex stock swap in 95, and the final bits and pieces of the original deal weren't fully liquidated until 2004.
The final outcome was just stark. On one hand, you have RJR's original shareholders, who sold out at $109 a share. They made an absolute fortune. On the other hand, you have KKR's own investors, the people who actually took on all the risk. They saw a dismal return. Their internal rate of return, or IRR, was less than 5%. I mean, they barely broke even after years of immense effort.
The whole RJR Nabisco saga really became synonymous with the excesses of that whole era. It served as the ultimate cautionary tale about the dangers of overpaying for an asset and using way too much debt. Its fallout fundamentally reshaped the world of finance, influencing everything from private equity fees to corporate governance for decades to come.
And this quote from George Roberts, one of KKR's co-founders, one of the architects of the deal, it just perfectly captures the painful lesson they learned from this epic and ultimately punishing battle.
So we're left with this question, right? How do you judge a deal that created enormous wealth for some, cost others dearly, and in the end changed the rules of the game forever? It's still one of the most studied and debated transactions in history.
And that wraps up our look at the RJR Nabisco buyout. Thank you for joining us.